Well, hello, this is Jeremy North with your educational and economic update for February 2021. Well, in this month's video, I will discuss major headlines that influence markets in January of 2021. As always, please stay tuned at the end of this video for my required disclosure statement. Well, stocks were mixed in January as we had somewhat of a sell-off in the last week that kind of brought the markets down. This was mostly due to the excitement and concern around the GameStop stock's incredible run-up amid what Wall Street refers to as what they call a short squeeze. As you may have heard, hedge funds who want to bet against stocks can do what is called short selling. This is basically borrowing the stock from a brokerage firm, then selling those borrowed stocks, knowing they'll have to buy them back later, but hoping at a much lower price. In the case of GameStop, regular investors targeted through group social media to buy up the GameStop stock. There was so much buying that the hedge fund investors were having to buy back those stocks to cover their short sales at higher and higher prices. Thus, they were forced by rising prices to cover their losses by creating what we call a short squeeze. And the ability of these regular investors through social media to move these markets enough that caused hedge funds to lose billions actually caused some concern and led to somewhat of a sell-off in stocks towards the end of the month. But in any case, the NASDAQ ended January up about around 1.4%, while the S&P 500 was down about 1.1%. The Dow Jones was down 2%, and the 10-year Treasury was down around negative 0.72% for the month. Well, in economic news, the January employment report was disappointing as payrolls rose less than expectations. But also, the unemployment rate fell more than expected. Manufacturing surveys reported for January have been mixed, resulting in no clear direction. But a modest decline is expected after we had a stronger than expected data from just a month ago. Optimism around vaccines and fiscal stimulus seems to be offsetting new COVID-related weakness in the economy. COVID-19 infections slowed as the month progressed and vaccinations picked up. Interest rates remain low and are expected to stay for the near term. Returns for many categories of bonds are likely to be lower than their historical averages due to the Federal Reserve's low interest rate policy, as I have mentioned in previous reports. The Fed is dedicated to keeping rates low until evidence that inflation is again kicking in. Well, that was our quick wrap up for the month. If you have any questions about how the recent economic reports could impact your long-term goals, I am here to talk. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 636-896-4052. We are always here and happy to talk. With that being said, here's my disclosure that I'm required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investment involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North here. Have a wonderful month, and I'll see you next month. Take care. Bye.